Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So here's a headline for you. Black suit cybercrime gang is blamed for major CDK ransomware attack. So this is the deal. 15,000 car dealerships across the U.S. and Canada have gone days now without software systems that are crucial to running their business. And this is after multiple cyber attacks on CDK Global. Now, that company is just a handful of dealer management systems that provide auto retailers ability to basically function, schedule appointments, customer records, etc. And so apparently Black Suit Cybercrime Gang is blamed in that attack.
It's a real deal. A buddy of mine manages a dealership in Jersey, and he said it impacts everything they do. And the net result is it just takes longer to serve your customer, gives them more time to walk out the door. And so it's impacting, a little bit of an impact on units sold per day they're noticing. So they need to get that fixed as quick as possible.
And that's interesting. But also, like when you go to a car dealership, you already spend half your day there. So you extend it and forget it. Steve Mann is Bloomberg Intelligence Global Autos and Industrials Research Analyst, and he joins us now. Steve, you've been following this and the hack. What happened?
Oh, this is very significant. Paul just said he spoke to some of the dealership in New Jersey. If I've reached out to some of the dealerships that I've talked to, the impact is significant. It's not just only sales, but it's also service and parts. The system's interrupted to a point where they can't even get certain cars registered and delivered to their customers, the ones that's already sold. So, inventory is gonna get a little pickup. It's going to be, I don't know when it's going to get fixed. They probably have to pay that fine, and I think they will pay that fine. But at the end of the day, I think if I look at it from the automaker's perspective, it's a temporary blip. Inventory is going to rise, but I think sales will be delayed. And hopefully when this gets resolved, customers will come back. More customers will come back to the showroom.
And it seems, Bloomberg News reporting CDK plans to make the ransomware payment.
Oh,
God,
really?
That's frustrating. It's just, But I guess they kind of have to. I don't know. All right, Steve, talk to us about China, Europe, tariffs. We've got the European Union reporting. We talked to you last week, initiating some tariffs here. Mm-hmm. Now Beijing's kind of responding here. What's the latest?
Yeah, it's a big deal for the German, especially the luxury automakers like BMW, Mercedes, and Audi, which Volkswagen owns Audi. They have about 80% of the market, the luxury car market in China. So they sell a huge amount of cars in China. About a third to 40% of these companies' revenues actually generated in China. So they want to make good with the Chinese. As you know, Germany has been against the tariffs. So if the Germans are able to get something from China and help ease some of the tariffs, or China, if China can get the Germans to help them ease some of the tariffs in the EU, I think it'll benefit, potentially companies like Stellantis as well, which also has a new joint venture.
But here's
with
the
a Chinese
thing
company.
that I get confused: is that China's making a pitch to individual countries versus the European Union trying to operate as one body in relation to tariffs. And I wonder how that's going to work itself out.
Yeah, I think it's that divide and conquer strategy they're taking. So, I think the Germans probably has the most to lose out of the global automakers here. About 16% of their battery electric vehicles that are produced in China, it's actually shipped out globally. So China plays an important part for the BEV market as a low-cost producer. So, I don't think there's a lot of other automakers that are, that have that many BEVs produced in China and sold elsewhere around the world.
And Steve, just a red headline crossing the Bloomberg terminal now. Canada now gets into the game. Canada announces plan to curb imports of Chinese-made EVs. What's going on here? First of all, just give us a sense of, how good, how competitive are these Chinese EVs? Because if you tell me they're good vehicles, let's bring them into the market. I don't know.
Yeah, I think if you talk to some of the automakers, they actually have the same thinking. Let's compete, right? I think competition will make the whole industry better. You saw that with Tesla being the fourth or third automaker in the U.S. and actually helped drive a lot of the BEV costs down. But it's not surprising that Canada is implementing tariffs. They are part of the U.S.-Mexico-Canada Free Trade Agreement, and I think they have to close that door, that back door where the Chinese EVs can come in. It is very competitive. I think Chinese EVs are cheap enough that if some argue that even with the tariffs, even with some engineering change so that they fit the regulatory safety and emission rules here, it'll still be a very competitive price vehicle for North America.
So then to that point, we're waiting for Mexico now, right? Because I think we talked about this before. So not only is Canada going to put tariffs on EV imports, they're also going to curb imports of Chinese-made EVs. The idea is that if Mexico doesn't have any of those restrictions, that they can just import EVs from China and then through Mexico go into the U.S. And that's a different way of operating. When do we get that from Mexico?
I think there are some negotiation that's happening now with Mexico to kind of implement similar tariff. I've heard that Volvo is already kind of lobbying. Volvo is actually part of Geely, is actually lobbying the Mexican government to not implement, to not put tariffs in place. So the negotiations are ongoing. I don't think we're going to have to wait too long to hear any news from that.
All right, so stepping back a little bit, give us the latest thinking out of Detroit and other auto capitals around the world about EVs versus the hybrids. Is the hybrid going to be, I guess, the stepping stone to a pure EV environment, do you think? Is that still the thinking?
Yeah, I think that is still the thinking. I think with BEV sales slowing down or growth slowing down, the automakers do need something else to meet the CAFE, the fuel economy regulation, the emissions regulation. So hybrid is a stopgap measure. But if you talk to all the automakers, they're still spending a lot of money on BEV. They think that is the future because at the end of the day, hybrid vehicles do still spew out pollution or greenhouse gases. So these emission standards, these fuel economy standards, they're only going to get tighter and tighter.
All right, Steve, we appreciate it. Thank you very much. I feel like your sector is moving so fast right now in terms of all the rules and regulations. Steve Mann, Bloomberg Intelligence, Global Autos and Industrials Research Analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One of the pieces of news crossing the tape here, Alex, just recently is, Apple. There's some concerns there. The European Union regulators once again looking at a big U.S. tech company, in this case Apple, looking at their app store and maybe some abuses there. Tamlin Basin joins us here. Tamlin is a technology analyst for Bloomberg Intelligence. He was in the U.S., but now he's in London. How did he get to London? I have no idea how that happened. I did not approve.
I'm hoping a plane. A ship would take way too long.
Yeah, I did not approve that move. But anyway, Tamlin, thanks so much for joining us here. Tamlin, tell us what's happening with Apple today as it relates to the European Union and some of the regulators there.
Yeah, sure. So what happened today is the European Commission announced preliminary findings in an investigation into Apple under the Digital Markets Act. This is the sweeping new competition rules that the European Union just sort of implemented in March of this year. Now the findings of this probe relate to anti-steering rules, so essentially to Apple's rules that it has in place to sort of prevent app developers from informing users of maybe cheaper subscription options outside of the App Store. Now, this might sound familiar because just in early March, before the DMA took effect, the Commission did fine Apple 1.8 billion euros over sort of these same anti-steering policies. Now, what today the commission said is that Apple is still not complying now with the DMA in terms of really letting developers freely engage with users and direct them to cheaper options. Specifically, this kind of they want developers to be able to market within the app and show cheaper subscriptions within the app. So really, this is kind of more pressure on those sort of app store revenues that Apple.
So what does Apple say to that? Like, what's their defense to that? Because presumably they had months to kind of get it together.
They did, and they haven't responded. What they have said is they think that they do comply with all of this. What's interesting about the DMA, though, is that this is the DMA. The European Commission did play a strong role in drafting these rules, and it's also responsible for enforcing them. And there are a lot of subjective interpretations in terms of first complying with this. So I think what we are going to see is probably the European Commission taking a very strict view of what's reasonable in these circumstances, and probably really try to get strict adherence here. So it's going to be up to them to decide whether Apple is compliant or not, and then Apple can then sort of appeal to the courts. But I do think it's pretty likely we're going to see another fine in this and some behavioral remedies coming down the line.
You know, Alex, I love talking to Tamlin. Good guy, smart guy. But you know what? It just doesn't matter. Apple stock up 0.8% today. It's up 9% year to date. We've seen this time and time again where the Europeans just start nitpicking at these U.S. Technology companies. Tamlin, what's the feeling within the regulatory environment of Europe as to really what they're trying to do here? Because it just doesn't seem like it's even relevant. I mean, it just at the end of the day, they just whether it's Google or Facebook or they just write checks here to make it all go away. I mean, is that kind of do European regulators recognize that it just doesn't seem to be that immaterial what they're doing?
Right. Yeah, so I think if you look at this specific investigation, this is one that sort of came out of sort of Spotify, which of course is headquartered in Europe, and the app developers have complained that Apple is squeezing them too hard. So I think in some of these instances, Europe is trying to protect some local players by sort of ordering a sort of loosening of these rules that sort of maybe benefit the gatekeeper on the DMA, which would be Apple, Google, Microsoft, others, and they are sort of trying to show domestic industry that they're trying to pry open the markets. But I do think you're right that I think at this point investors are sort of kind of just shrugging this off. This is just one thing after another. I will point out that a difference under the DMA is that the timeline is really much quicker than under sort of former case law, where it may take 3-4 years until you got a result after an investigation. Here, this finding came just 3 months after the inquiry opened, and we're going to have sort of a final remedial measure by early next year. So I do think the timeline is faster. Whether or not this results in sort of the impact that the regulators might be looking for, I think definitely remains to be seen. And I think investors are definitely looking a little bit askew at it and thinking maybe this is sort of just more of the same.
And Alex, I mean, it's really almost maybe even more than 30 years ago that Microsoft started going through this same whole thing with the European Union. And again, investors became conditioned to, it's no big deal. They just write a check and it kind of goes away. The tobacco industry, investors kind of said, put it in context, it's not that big a deal. And you kind of wonder, given that the U.S. regulators have taken a very light touch to technology and then allowing these companies to get so big, it seems like the Europeans are trying to do what they can to kind of rein it in, but it seems almost too little too late. Right,
and also you can make the argument too that Europe doesn't have a lot of technology companies. They have some, of course, like ASML, for example.
Yeah, SAP.
But, yeah, exactly, SAP. But I mean, can you name any more?
No,
I'm sure there's some, but I think that's kind of the point. If you take a look at European stocks versus the S&P in market cap like 20 years ago versus now,
yep.
Oh my gosh, forget that.
Really different.
Hey, Tamlin, what's going on with Apple in general? Like it seems to be making a little bit of a comeback here. It's actually up 0.6%, despite Nvidia, for example, down over 2%. What do you make of that?
Yeah, I mean, I think some of this comes from sort of the recent announcement to sort of build AI into the iPhone and maybe sort of accelerate the recycle in terms of getting people to buy those phones. I do think it probably definitely. I don't think the the regulatory headwinds are really causing it much damage right now. I will point out that although the U.S. is definitely, like Paul said, taking a light touch approach, the one area they are getting involved in is on sort of these App Store rules, where Apple's obviously been in litigation with Epic for years and years and years. So I think on both sides of the Atlantic, there are some pressure on those services revenues that we might see shaking out over the next 9 to 18 months to see how that plays out.
So Tamlin, you've been based both in the U.S. And now in the U.K. What's your view of kind of the technology and landscape and the ability for new technologies to kind of be developed and to grow in the U.K. and Europe? What's your view, given your experience in the U.S.?
Yeah, well, I think the U.S. probably has more of a fostering environment for that startup stage. I think that's why you've seen some of your U.S. companies really flourish. I do think in Europe, they're trying to create that fostering environment specifically for the artificial intelligence field. I think you have seen there's an AI regulation that's taken effect, but I don't think it's nearly as strict as it could have been. And I think a large reason for that are lawmakers, specifically in France and Germany, really wanted to try to foster and incubate these AI industries that they had going on. So I think we'll have to see whether that works out and whether we have some European large-scale AI players. I think historically, it definitely, I think you've seen more of that sort of startup fostering taking place in the U.S. than in Europe.
All right, Tamlin, we really appreciate it. Thank you so much. Do you like living in Europe, by the way? Are you enjoying the UK?
Yeah, quite nice.
Excellent.
Beautiful.
All right. I get you. It's not 92 degrees there
Yes,
with humidity. I'm just going to put that out there.
No.
All right, Tamlin, we appreciate you. Thank you, Tamlin Basin, joining us, Bloomberg Intelligence technology analyst from the UK. So here's my question for you, Paul. What do you think is going on with tech right now? Like, is this like a rebalancing to the end of the quarter? Is this like a pause? Is there something more disastrous going on here? What do you think?
I don't think so. I mean, again, I just got a note from Vince from out in the audience. Bid in stocks is quarter end window dressing. That's all he's hearing so far. Vince Signorella kind of writing in here. So, no, I think tech is, I just think it's a pause here. I mean, I think they're going to be, the question for a lot of folks is, tech has been the leader in this stock market performance for years now. Can it continue to be? Mm-hmm. And I just think you look at the tech spending and you see where it continues to be a significant growth story. And just in terms of total tech spending throughout the entire tech stack, led by AI. So maybe the AI trade maybe got the sector a little ahead of itself, maybe time for a pause. But boy, that longer term trend seems really solid.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The NASDAQ is flat on the day. I mean, go figure. I feel like we're definitely clawing our way back. Lorraine Gilbert, CEO of WealthWise Financial, is joining us right now for her take. So, Lorraine, Paul and I were talking just earlier about what is going on. Is it a tech breather? Is it rebalancing into the end of the quarter? Was last week kind of the start of something more severe? How do you view it?
Yeah, I mean, I think that let's not forget it's starting to be summer. People are off to the Hamptons, off to international trips, etc. So part of this would be just seasonality. But another part is I think we're going through a shift when it comes to AI from development to deployment. And so I think with that, we're going to see a broadening out of the market, not just the companies like NVIDIA that are the start of AI, but moving into how companies can monetize it. And so I think we're going to continue to see this broadening out with other companies that are able to actually profit from it.
What are some of those companies, or what are some of those sectors that can benefit from the actual deployment of this technology?
Well, it goes across all sectors, really. But when we think about even just industrials and how the technology here is going to be able to broaden out. Even companies like Caterpillar and John Deere are going to be able to use AI to improve efficiency. So really it's across all sectors, whether it's healthcare or industrials, etc.
So that's the AI play, and then you do like plus, let's look at valuation and where we're at. What's a good bet? Like, do you like industrials right now?
We do like industrials. We think that that is going to be a backbone. And when we look at infrastructure spending, that is going to continue to be a theme. So, and I think we have to take in mind where we are with the Fed and that we're definitely about to see rate cuts, and the question is just when do they start? But we know that trend is going to be our friend. And so I think you can't give up on technology. It's going to continue to be the driver here moving forward. And with interest rates that will go down, that's a risk on move in the market. So we have to be mindful. But it is all about what are you buying and at what price?
All right, Lorene, you're a graduate of the University of Texas. So that means by default, you must have an energy call. What do you think energy stocks are going to be doing here? How do you think about investing in energy stocks?
Yeah, we like energy a lot, and we like utilities. Looking at the play, just continued expansion and the need for energy with regards to AI. If you look at those numbers, they're astronomical. And so there has to be this continued build out and making energy more efficient. So we definitely like the energy play.
Where in the energy play? Because this is something that I've been thinking about. Like, oil companies aren't power companies, and power companies are the ones that are going to benefit. But utilities are regulated. So does that kind of change how you want to be investing in utility companies versus power companies? Where on that spectrum it makes the most sense?
Yeah, so it's true that utility companies are regulated, but what we're seeing is that there's just so much demand that the demand versus supply is going to be the story there. So definitely there, I agree with you, not so much just oil and gas companies, but really everything that is behind the idea of what's going to help with AI.
All right, so how do we think about equities? How about fixed income here? What are you telling your clients these days about bond market?
Well, we love the bond market. We couldn't be, more excited about bonds, and who gets excited about bonds? So right now is a very good time because when you look at where we are once again with rates going to be going down, the story is that all that money that's sitting in money markets is going to be moving. It's already started to move a little bit. And while some of it may land in the equity markets, a lot of it's going to end up in the bond markets. And so with that, now is the time to be moving money because for people that are going to be in money markets, a year later, they're going to be very disappointed. And moving into the bond markets now, you have the yield, but you also have capital appreciation opportunities. We like preferred stock as well. That's another good play. That's fixed income to equity. So keeping it, though, I would say all high quality, not venturing into, as our economy has been softening, keeping it on the high quality side.
This brings up my question that I have is that why are we convinced that money market funds are going to go somewhere else? Because if we're in a rate normalization cycle, it doesn't mean we're going to go back to 1% on the Fed funds rate. Like if we stay at 4, I don't know, 3.5, like why would I maybe take on more risk when it can sit there and still make money?
Well, because what you're doing is locking in to a higher rate for longer by moving into the fixed income markets versus seeing the rates continue to go down in money markets. So right now, if you move into just a 6-year duration on your fixed income, you're looking at between 4 to 5% on the yield with some capital appreciation opportunity that you can lock in for the next 6 years. That's what history tells us. So I'd liken it to, if you could go back in time a couple of years ago and lock into a home mortgage rate at 3%.
So if you could be Alix, basically.
Yes.
So if Paul Sweeney could go back in time and be me, that's what he would do.
Be ecstatic about that. And so similarly, right now we have the opportunity in fixed income to lock in at the higher rate for a period of time and instead of watching the rates go down.
Lorene, you mentioned preferred stock. We don't talk about preferred stock a lot. How do you use preferred stock in your portfolio? Why is it attractive right now?
Yeah, so we use it as part of our fixed income allocation because you're getting a yield from it. But you also have equity-like exposure with some upside there. So it's this hybrid, as it were, and it gives off a very nice yield while you're waiting. So it is kind of this more conservative way, more conservative approach, and looks very attractive right now.
What do you think of corporate credit?
Well, I think that we would prefer agency mortgage-backed securities. Corporate credit, you in a diversified fixed income portfolio, you're going to have some corporate credit, but more so than that, agency, even treasury, but a smaller allocation, I would say, to corporate, just with the softening of the economy.
Lorene, I was speaking with a large group of registered investment advisors recently. I was surprised by how aggressive they were in terms of allocating their clients' portfolio to alternative investments, whether that's hedge funds, private equity, private credit. How do you view alternatives in a client's portfolio?
Well, I think alternatives have their space, and we allocate to alternatives as well, but it is a smaller piece of the puzzle. So, we look at, how much between equity and fixed income, and in all alternatives, in general, we consider that part of the equity exposure that gives us more diversification than just going long on equity. But I think you have to be careful because some alternatives can lock you in for a very long time. So liquidity needs have to be considered. And the other thing is, as they can be a diversifier, but that doesn't always mean that they're going to outperform other areas of the market. So yes, we use it, and we're always looking for what the opportunities are. I think there's been quite a bit of investment in private credit as an alternative investment, and I don't know how much more legs that really has.
Great stuff. Really appreciate it. Some counterintuitive views there. So fun to get. Lorene Gilbert, CEO of WealthWise Financial, kind of, sort of tempering expectations when it comes to private credit. Maybe it's not the bazillion-dollar industry that we all are thinking. Yeah,
and we'll see how the asset class performs here with these higher for longer interest rates. Because you've got to, now some of the banks are kind of getting, maybe getting a little bit more aggressive in their leverage lending businesses here, trying to, kind of compete a little bit better with this private credit. But the private credit's done really well, particularly in the middle markets where maybe some of the regional banks have, dialed back since a great financial crisis, their risk-taking environment. So keep an eye on that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news and analysis with our analysts from Bloomberg Intelligence. They cover 2,000 companies in 130 industries worldwide. And Friday means the end of the second quarter. We will be halfway through the year. So it's that time when we're getting all the mid-year outlooks, which are super helpful, particularly from Bloomberg Intelligence. And joining us in studio is Michael Halen. He's Consumer Products Senior Bloomberg Intelligence Industry Analyst. Michael, in studio, we're very excited about this.
I'm excited too.
Thanks for joining.
He finally
came in.
Pass was.
Yeah.
It took New Jersey Transit. I was digging through my junk drawer, but I found it.
He found it. It was just important. Well, is New Jersey Transit even running? I think is more the question.
So. It's tough.
Nice. Okay, so mid-year outlook. Give us the broad sweeps. Like, what are you expecting for the back half? And then we can get to specific stocks.
Yeah, sure. Broad sweeps, I'd say sales are probably looking a little bit better just because than they were in the first half, because the year-over-year comparisons are getting easier. Higher income consumers should have money to spend, right? We see stock markets at all-time highs. Bitcoin's having a rough day, but not far off the highs, and home prices have held in despite the higher rate. So those should kind of buoy restaurant sales. But on the other end of the K, the low-income consumers continue to struggle. consumers under 75,000 were cited by Darden the other day on their earnings call as struggling, especially consumers that are earning less than 50,000. So we have kind of a push and a pull there. Margins are okay. We would like to see better sales because that's really what drives most of the margin expansion in that business, right? There's a lot of operating leverage in the model. So maybe some modest margin expansion. And the stocks generally haven't done so well this year. What we wrote is that we think we're going to see a larger spread between the stock market, the market share winners and losers this year, which we've largely seen in the first half. You've seen stocks like Chipotle, absolutely knock the cover off the ball again, and really appreciate where other chains like Darden, Darden's done pretty well. Like Bloomin, I should say, is kind of struggled in the first half, and you've seen that stock, sell off pretty precipitously.
Talk to us about California and their new minimum wage law. What's the impact been on the fast food business?
Did we just have like a famous Hollywood restaurant close because of that? Like a famous Hollywood McDonald's or something?
Oh, San Fran.
Yes.
They announced today San Fran closed. Yeah. So it's not been good so far. April results were kind of in line with the U.S. in terms of same-store sales at quick service restaurants. But I think everybody went in April and then they got sticker shock and they did not return in May.
Because the McDonald's of the world, the restaurants in general in California, are they raising prices to cover their higher labor costs?
Yeah, high single digits is typical,
that's a lot.
which is a lot. And that's not even covering it because the traffic loss that we've seen here in May, it's not even going to cover it. So they may even have to raise prices again if they can. Quick service California same-store sales underperformed by almost 400 basis points in May versus the U.S. Yeah, so what we wrote is that we expect quick service to continue to outperform casual dining just because it's a cheaper check, even though it's gotten all the bad press about the $18 Big Mac meal, $22 smash burger meal. It's still, you can eat there a lot cheaper on the value menu and stuff like that. Also, chains are starting to discount more. Burger King and McDonald's, $5 meals, things of that nature. But California is definitely going to weigh on quick service growth throughout year end, for sure.
So as the K-shaped recovery grows even wider, it feels like so do the valuations of those companies that service those two lines. Is that a fair statement?
Yeah, if you're a chain that can attract high income consumers, like Chipotle's done such a good job of doing, and McDonald's has done a good job of it as well since the start of the pandemic.
Chipotle is your Wednesday day, Paul?
It varies, but it's one day a week they get Chipotle. But here's a funny Chipotle story. They got slammed in social media for underfilling their tacos and things like that. Now they've gone overboard and they overfill them. So the net result for me, instead of getting 3 hard tacos with chicken, and I'll give you the whole order later, I only get 2.
Oh, there you go.
So it's got to be hurting their sales. So that is an interesting tidbit.
Yeah, so we were thinking about doing some work into it, but we haven't done anything yet.
All right,
there was definitely some heat and some shade thrown at Chipotle for a little while there.
I'm going to say a year and a half ago, somebody came in here. This is kind of the beginning of this whole AI thing. And somebody came in to this studio and said, one of the biggest areas is going to be, for example, drive-through. Going through a drive-through at McDonald's, it's going to be all AI, blah, 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 blah. So my question to you is, are local, McDonald's or Burger Kings, do they have fewer employees because they're using technology or at all like that?
Well, they have tried to cut labor hours in other ways. That's a goal using AI for sure. It's been harder though at the drive-through than anticipated. A lot of things, just like accents, something like that. Actually has caused some issues. Something else, they're also using AI with these cameras that are using AI to see if orders are being packaged correctly. Since takeout and delivery has become such a big part of these businesses. But, one of the companies that was doing that got caught using people in India watching screens, videos, supposedly quote unquote AI. So we're not quite there yet with the AI in that
That's so
part
interesting.
of the business.
Because like the practical application, like how it really makes a difference, we may not quite be there yet. Here's my question. If you and Ken Shea from Bloomberg Intelligence, who covers many things, but in particular, he covers all the cannabis companies, got together, like, what is your interplay between you guys? And I'm not actually trying to be that funny, but like, you know, with all the weed stores coming up and you can get kind of cannabis anywhere in many places, like, does that have a direct impact on the companies that you cover? Like, have you noticed something along those lines?
They haven't necessarily attributed any, lower alcohol sales to that,
or like more food sales or like munchie sales.
Yeah, I mean, we've had some of our companies like Jack in the Box and other companies that do a big late night business kind of lean into that stuff on their advertising. They've used Snoop, in some of their stuff. I think Ice Cube now is
But on the flip side of that is the GLP-1 situation.
Truth.
Is
yes.
GLP-1, is that real? Because your companies have called it out.
Yeah, but like the panic over it seems to have subsided.
Okay.
Is it real? Yeah, but there's still a lot of question marks. There is definitely concern because like people are less likely to go to fast food restaurants. Like there's a lot of people saying they feel sick eating fast food on GLP-1s. There's a lot lower alcohol consumption on GLP-1. So it's definitely something that's being monitored. But right now it's still like such a small it's just had such small distribution so far. I think what's going to be more of a concern is once it's in a pill or something that's easier than a shot.
Yep.
Right.
It's interesting. So I'm looking at the S&P Restaurant Index VAT member returns. One of the second worst performing stock for restaurants is Cracker Barrel, Old Country. That kills me because I'm a huge advocate for Cracker Barrel. So I don't know why this stock's not working.
They're renovating the stores. So.
All right. I'll go out and get my country boy breakfast. All right, Michael Halen, Bloomberg Intelligence, thank you very much. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, for the month of June, Bloomberg Radio is committed to bringing you segments and guests focused on the topic of equality. Today, we're speaking with Mike Hyder, President and CEO of Executive Leadership Council. Mike, thanks so much for joining us here. Tell us what the Executive Leadership Council is. What are you guys doing over there?
Well, it's good. Thank you for having me. It's nice to be here. I appreciate it. The Executive Leadership Council, otherwise known as the ELC, we're an organization of the highest ranking Black executives in global organizations worldwide with a commitment to the leadership and development of talent in corporations. Been around 38 years.
Right. Good stuff. What are you finding these days, just in terms of overall that DEI concept, which had been ascendant for many years, and for some people it feels like it may have peaked. How do you view that commitment?
Well, the diversity, equity, and inclusion is and continues to be a very strong element and element for organizations that are beneficial for them. Unfortunately, there's a lot of heated rhetoric about diversity, equity, inclusion, I guess, being perceived as reverse discrimination. Which we fundamentally disagree with that assertion. It is failing to sort of readdress the facts that diversity, equity, inclusion has actually benefited the United States economy over the years. But it just has to be focused properly in order for that to happen.
How do we do that? How is it focused properly, and what are the steps that need to be taken now?
The steps should be that diversity, equity, inclusion should be considered the impetus behind superior business performance, increased access and opportunity for development for all people, and that focusing on building corporate culture to increase and enhance the engagement of as many employees as possible is what diversity, equity, and inclusion means. It doesn't mean lowering standards. So if it's applied as the significant contributor to the business driver that it is, then it will be strategically relevant in the organizations, and less concerned as something that is being merely tolerated.
So, I mean, give us a sense how you think about this, Mike, and how your council thinks about this, because again, it seems like DEI is sharing a similar type of situation or environment as ESG is, environmental social governance investing, is people are just kind of pushing back on both of those types of initiatives, whether it's from a political perspective or a business perspective. How do you think about that?
Well, it's unfortunate that that's been the case. We're focusing on, organizations need to be, and shareholders and customers are expecting, and employees are expecting companies to be peak performers. And specifically the ELC, we are corporate officers that are executives in major corporations around the world. So we look at the diversity, equity, inclusion as a piece of increasing the effectiveness of an organization's ability to be more profitable and be more successful, as how we would suggest organizations focus on it, as opposed to it being something that's perceived as a political issue.
What do you think would be helpful, Mike? Because to not politicize it just a few months before an election that will definitely politicize this, how do you sort of manage that?
Yeah, that's an excellent question, and I guess the challenge of the day. Our assessment on managing it is staying focused on what is required to be functional on the ground in organizations, and to be less, I guess, less defined by other people's assessment about what it is or it isn't. That's the only way we think is the best, I guess the best avenue is to be consistent for addressing what I call disparities in terms of numbers based on representation of talent within organizations, and to have talent strategies and development strategies that ensure that everybody is reaching their full potential in organizations as our suggestions for what organizations ought to do, and to stay focused on that independent of what it's called or independent of what the acronyms are that people are defining it by.
Mike, you mentioned that the ELC is a global council, a global entity. Given your global view here, how is the U.S. doing on DEI initiatives, maybe versus some other parts of the world?
I think it is mixed relative to other parts of the world, but I do believe that the focus on productivity and team benefits globally is much more pronounced, and it's less defined by race and culture, and so it has less baggage, I guess, if you will, relative to how it's perceived globally than it does here in the United States. I think team productivity, maximizing the contributions of all types of folks, independent of their background or gender or sexual orientation, continues to be something that all organizations are striving towards. There are some companies who are more effective at it globally than others, but I just think the whole issue around the discussion that you all are referencing is primarily much more, I guess, aggressive in the United States, because I think there is an over interpretation of this as a byproduct of a racial issue, as opposed to something that is looked at as a full production of all types of people, independent of race, in the United States.
I think that's such a great point, that it gets stuck on race versus all diversity. Like, you need full diversity in order to sort of deliver that profitability, to deliver synergies, etc. So yeah, it's true. All right, Mike, we appreciate it. Thanks very much, Mike Heitcher, President and CEO of Executive Leadership Committee, ELC, joining us, Leadership Council, joining us on all the efforts through DEI. And, you know, I wonder what this happens sort of once we get past November, Paul, like what the result will wind up being. Does this conversation get easier, get harder? Can we refocus it into diversity is good for many reasons? Here are the numbers that show it versus making it a race issue at the end of the day.
Yep, exactly. If you can put it in the context of profitability and returns, that's probably what get the board's attention.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.